Good morning. Thank you for joining us for today's coffee talk. My name is Sean O'Brien, president of QuickRate, and as always, I'm pleased to be joined by Steve Huntington. Steve, go ahead and introduce yourself and say hello.
Sure. Thanks everyone for joining us again for another installment, Friday morning installment of our coffee talks. My name is Steve Huntington. I'm the director of analytics here, and I've spent my entire career working with community banks all over the country, and everything from model building and maintenance to M&A to capital raising to valuation to analytics. And I spent more than half my career here, I guess about 13 years or so, working with Sean, developing QwickAnalytics.
Perfect. Thank you, Steve. Welcome, everyone. Just a couple of reminders. As most of you are repeat attendees, I'll still say it out loud. The Q&A box and the chat feature are where we welcome your questions. As you know, we'll try to monitor those throughout the discussion and either drop those in during the course of the discussion or certainly take them after the presentation is complete. I think, why we're here today, right? We continue to offer these. We want to make sure we provide you with an opportunity to discuss questions to continue to increase your knowledge, ask us, about improvements or just enhancements. But I think these have gotten much tougher to talk about, right? I think all of you are doing such a great job managing your reserve and utilizing the tool. We're certainly we want to continue to make these relevant. So certainly are welcome any ideas or topics you'd like us to cover in the future. But again, I think goes without saying that hats off and congratulations to all of you, because I think you're handling the reserve process exceptionally well. As we've done, typically we'll start the discussion today with some polling questions. There's just a few today, so certainly appreciate your participation in any of these. Pretty straightforward questions today. First one's just about the credit environment and kind of how you're feeling about your credit environment and your borrowers. Do you see them strengthening, weakening, or stable? It's 15 to 30 seconds, and then we'll move on to the other two. Share these. So 56% of you see the environment and your borrowers is stable, 37% weakening, and 7% strengthening. So that I wasn't quite sure where we would fall today. I think it feels very volatile in my head. Some days I wake up feeling really strong about where things are going, and other days not so much. So this is I was interested to see how everyone else is feeling. All right, so thank you for answering that one. We'll move to the next question. Just around past due loans, are you experiencing any increase in your past due loans? Just a simple yes or no. I think I was just in Georgia last week presenting, and again, I think one of the things that's we've certainly seen is, well, problems have not risen to the level of charge-offs. We certainly have seen increases in past dues, across the country this year. So. All right, this is encouraging. 59% of you are not. 41% of you are seeing an increase. So again, thank you. And then for our final question here, just charge-offs. Did you have any charge-off loans this quarter? Just again, a yes or no. Okay, and this one pretty split as well. 52% of you did not charge off any loans this quarter, and 48% of you did. So again, thank you for participating. These questions, along with a copy of the slides and a link to the recording, will get sent out to you early next week in an email. So we will incorporate the results into that email. But as always, just look either late Monday afternoon or first thing Tuesday morning for an email from us. So again, thank you for participating in those questions, polling questions today. Okay. As always, we want to keep you aware of any updates or enhancements. Many of these, excuse me, we've covered in previous coffee talks, but we just kind of keep this reminder in front of you. We are, again, constantly trying to tweak to improve not only just the user efficiency of the tool, but other areas where we think we can bring improvements, access to additional information, insights. We are never ending in that pursuit. So, Steve, anything you want to discuss here before we get into the next couple of slides?
No, I think we're going to be talking about the upcoming enhancements, and we're going to do a little bit more of a deep dive into the current enhancements in industry trends and what's going to be coming down the pike very soon when it comes to unfunded method commitments. So let's just go ahead and dig in.
Jump in. Yeah, perfect. It sounds good. All right. So just before I turn this over to Steve, again, I think a couple of areas that have increasingly now started to get more, what's the right word, or how should I characterize this? Interest on the part of regulators and auditors is just how we handle unfunded commitments in our tool. Again, when we built the tool, there was no prescription on how banks should handle this. We built what we believed was and has been proven to be an effective way to deal with it. But we recognize there's a very large spectrum on how you can think about these or how you might want to simplify it, et cetera. And so, as with everything, we're not going to change it. We're simply going to give you another option or way to deal with these unfunded commitments. So at this point, I will turn it over to Steve.
Yeah, thanks, Sean. So as Sean mentioned, there will be no changes to the default method for calculating unfunded commitment reserves. Once we've implemented this enhancement, you'll have the choice of two different methodologies: the existing default current one, and then what we call a simplified method. Not that the existing method was overly complex, but a little more streamlined and straightforward, I would say. And once you can run it both ways and see which way you prefer from a methodology or an outlook standpoint, and then choose in the overview which method you're going to utilize and which one you want to export and save along with your scenario. So the concept when we were originally developing the tool, again, the tool evolves as regulatory expectations evolve. The first time around, when you first had an audit or an exam with CECL, our regulators were looking for what they called a good faith effort, an attempt to apply CECL in a way that they found appropriate or acceptable. And as we all expected that in this second round of exams, we would see more sharpening of the point, so to speak, and higher level of expectations from auditors and examiners as they started to develop their own preferences of methodologies as they saw more and more institutions implementing CECL and what works and what doesn't and what they liked and preferred and did not prefer. The way we've done the unfunded commitments up to this point, there's a little bit of a disconnect conceptually, which is I think where when some of our customers have called in saying that they need a little bit more discussion with an auditor or an examiner about the unfunded commitment methodology, was that when we're calculating the reserves on the existing funded loan portfolio, the whole concept is shifted right under CECL from calculating things on a year-by-year basis to calculating a reserve losses over the remaining life of the loans, right? So the forward-looking period is not like a single year, but over the entire remaining lives of the assets. However, on the unfunded section, due to a couple of the assumptions that we wanted to give you some initial guidance or kind of a starting point on, for example, specifically the estimated probability of funding. There is very little good guidance out there in public, at least, that gives us some suggestions for starting points for estimated probability of funding. And what we do get comes from kind of deep in the guts of the regulatory capital section of the call reports and the FDIC's own research. However, they did a lot of research on probability of funding over a specific period of time, like over a year. And so the way we developed the tool for unfunded commitments was we would estimate probability of funding over, let's say, a year-long period, and then we would consider the length of the remaining commitment. And then we would take our lifetime loss rates that we calculated on the funded portfolio, and kind of mold them into that by turning them into annual loss rates, and then going sort of back to a lifetime estimate. So we would kind of flip-flop a little bit when it comes to lifetime remaining concepts versus annual expected loss rate concepts. And while the methodology is sound and still the preferred one for most of our customers moving forward, that's where some of the confusion, I think, has come in. And so the idea was to simplify by simply keeping things on a remaining life conceptual basis and utilizing the warms of the existing portfolio without any sort of modification or alteration of it. So if you head to the next slide, Sean, the simplified method, at least conceptually, is just more straightforward, right? We start with, up until we get to the net unfunded commitment amounts, there's no change in the methodologies for sure. Then the probability of funding becomes, instead of trying to estimate a probability of funding over a 6-month or a 1-year period, just simple, what's the probability that these commitments get funded, period, at any point in the reasonably near expected future. And then from there, you actually calculate an estimated total amount funded. So the step that was kind of skipped or intuited in the existing methodology, but is explicit in the simplified method, is this is the amount of these unfunded commitments that we expect to turn into actual loans. And then from there on, once you have an actual expected loan balance amount in the future, you simply just apply the existing current lifetime WARM, right, of the portfolio directly from the other part of the tool, and pull it right into the unfunded commitment. So you end up with an estimated amount of actual future loans, and then simply the WARM that matches your WARM on your funded portfolio, multiply those and get an implied expected loss rate, expected loss amount, which equals your implied CECL amount. So it's just a little bit more conceptually straightforward. Depending upon what assumptions you use in the default method, it might end up resulting in a higher or a lower CECL or reserve amount for the unfunded commitments. I would say on the whole, it's a somewhat more conservative approach, I would say. So it's more likely to result in an increase in the necessary reserves on the unfunded commitments. Now, I will temper that statement or explain that statement in more detail by saying that all that does is mean, if you do end up using the simplified method and it does result in a larger necessary reserve on the unfunded commitments, it's just really pre-funding or preloading your reserve a little bit further up the timeline, the stream, right? Because if you end up funding the unfunded commitment reserve a little bit more, when those loans become funded, you'll have more to transfer from the unfunded commitment on the liability side of the balance sheet, the reserve right there, to your loan loss reserve on the asset side of the balance sheet. So it ends up being a one-time upstream transition of a small amount of reserve if it ends up amounting to an increase. So you can, which means that, it at least from a regulatory standpoint, if you're uncomfortable or didn't like or were fighting an uphill battle, so to speak, with the default method, the simplified method, if it results in a slightly higher reserve on those unfunded commitments, will meet with less friction from your examiners in making the shift if you decide to do that. If you want to kind of, yes, Sean.
I'm going to jump in. We had a question come in, which will be pretty straightforward, but I think it's a timely question. Does the simplified method have all of the footnotes at the bottom of the screen to explain the hows and whys?
It does. It does. Yeah. They don't do well for screenshots on presentations because it's too much fine print. But yeah, the fine print's there, and we'll also have a separate description of it elsewhere that you can provide to an auditor or an examiner who is curious about the methodology shift on this, albeit small piece of the overall reserve puzzle. And we'll also be attaching a transcript and video of kind of video clip of this conversation right here, right on the page. So anytime you're going to reference it, you can always just kind of rewatch this few minute clip here and get a little refresher of it.
I just remind you again, in column F, right, and D, obviously, gray boxes, blue numbers in CECL and throughout QwickAnalytics, right, are fields you can override. So, right, even if you just wanted to tweak those.
Yeah, and the ones on the left, the dollar balances are coming straight from the call reports. They can certainly be modified to be more current than the last quarter end, or for any other reason that you want to modify them, but they are coming from their actual historical data. The probability of funding column, like there's a very large table and footnote that explains what that is and where those default values come from. But that's something that we have an expectation that you'll make your own in one way or the other, whether it's much larger institutions sometimes have to actually do a probability of funding study on their own historical data, but that is much significant overkill for the vast majority of community banks, and we haven't seen that expectation pretty much ever in discussions. However, the default values we use there are, again, just coming from some old regulatory some regulatory calculations that apply to an extent. And so considering if you believe that those are appropriate for the current state of your institution and your portfolio is certainly up to you. And again, those lifetime expected loss rates will come directly from your WARMs on the funded portfolio. However, we do have an apples to oranges situation, right? We spoke about this in the past, and we have a couple videos that we've done explaining that what I mean by that is the unused commitment buckets are not the same exactly as the funded loan portfolio buckets, or we'd have 15 rows here instead of 7 or 8. So in a situation where the unfunded commitment values come from 2 or 3 schedule RCC loan portfolio line items, we average those loss rates from the funded portfolio to get a blended average for the appropriate buckets to map to the unused commitments buckets. That would have just been a little too easy, I guess, if they had designed the call reports on an apples to apples basis.
So Steve, a couple more questions have come in. The first one is the probability of funding what you think the percentage will fund, or the percentage you think the entire amount will fund?
The percentage of the entire balance of unused commitments that you expect will become funded in a reasonable forward-looking time frame. Reasonable is crazy subjective, obviously, but that's the way that's what we've been given, so that's what we present.
Maybe think about utilization, maybe. All right, and there's one more here. Let me check the chat. I didn't pull it up. I saw it. Let me get back to it. An interesting poll question on unfunded commitments, maybe to ask what percentage of lenders utilize on-demand note language in their standard line document that allows them to exclude this availability from their unfunded commitment reserves. We do not take this approach, but a few of our competitors appear to have done so. So, Doug, thank you. That is a good poll question. We'll make a note of it and ask it next month.
Yeah, it's a great question, and what that'll mean on your bottom line, of course, is just how far upstream or downstream you end up funding this potential loss, right? If it's an unconditionally cancelable amount, and you're not, which means you can back it out from the reserve for the unfunded commitments, you end up lower there. But if that commitment becomes funded, you end up having to reserve more for it on the funded loan portfolio side. But still a very relevant question for the analysis.
Yeah, and I think even with this, I mean, I think we talked about from the very beginning that there was going to be an evolution and a life cycle of within CECL and the ACL. I think the unfunded commitments are beginning to tell that story, right? That if you think back at the start, and we certainly discussed it a number of times in the coffee talks, not many of us were funding the unfunded commitments at all, right? Because we just looked at the idea was, hey, these are not loans yet. We're not reserving for them. Fast forward a couple of years now, over half of us 2/3 of us are funding this to an extent. And then I think as Steve just articulated, right, you are kind of in some ways pre-funding, with this, with these unfunded commitments, or could think about it pre-funding potentially, right? And I think, if I'm sitting here today, I think that might be, again, albeit very slowly, but I think that may be a path, you start to see regulators move towards. I don't know if they will or not, but like it wouldn't be out of the realm of possibilities that they started to view it, in that manner. But
becomes a path of least resistance, right? If they
yes,
start looking for that and and expecting it, or being harder on you if you haven't done that, it might just be easier to put a little bit more weight on this side and then have a little bit less to worry about when it does, if and when they do get funded, which does put more emphasis or importance on an accurate estimate of the likelihood of funding, right?
yeah,
But we're going to inevitably, we're going to have this back and forth on our on our provisions, right? Because that's where we manage the changes, not only to the loan loss reserve, but also to the reserve for unfunded commitments in the liability side of the balance sheet. Our provision expense now has multiple components. It has the provision expense going into the funded portfolio and the provision expense for the unfunded commitment. And as large chunks become funded, the amount of reserve you need in the unfunded section may be dropping. So you end up having a negative provision for the unfunded commitment, and then kind of a positive provision, so to speak, for the reserve, and it becomes more of a transfer than an addition.
yeah, yeah. Just like I said, just crystal ball and things, but just clearly we've been on a path of, again, most of us had zero. Now most of us don't have zero, right? What prompted that change, right? Something changed. And so to me, it was just kind of how they're thinking about these. Unclear how that's going to play out and continue to play out in the future, but clearly there was a direction shift that needed some more focus on this. And we'll wait and see, but you have to take note of the fact that the trend did change.
Yep. And
Uh,
I will point out that our expectation certainly was, as our tool would evolve to meet higher regulatory scrutiny over time, that it would probably have to become more granular and more complex. Pretty happy that not our first, but one of the change ends up being streamlining and simplifying what's already a relatively straightforward tool. So from that perspective.
agree. All right. So as we touched on, and
That's
Steve will
just to
go,
remind everyone
yeah, but I think
that it's a small piece of the pie, right?
it's a small piece of the pie, but clearly has shifted over time, right?
Yeah.
If you go back even further, like we were way much lower.
It was 80% before. The a reserve for unfunded commitments was not a new line item on the call report from CECL. It has always been there. But it was zero for over 80% of community banks up until CECL, and it's slowly trickled down by a couple percentage points each quarter, going all the way back to 2021. And now it's down to probably around 30%, meaning 70% of community banks around the country are calculating a reserve on their existing unfunded commitments.
Right. And again, I think just directionally and trend wise, right? You could see the percentage reporting zeros gone down. The median, most of us are just trying to get some, value in there. But when you start to look at the 75th percentile on this, right, it does tell you a different story, right? And so clearly, those banks in the top quartile, right, it's an accelerating rate of a reserve. And to me, from the outside, like the question I'm immediately wondering is, why is that, right? And again, I think over time we're going to start to see that better explained and probably more flushed out. But I think it, just from where we sit today, right, it's just clearly a trend that has moved in a particular direction. So one, we're trying to address it, but two, we're going to continue to monitor and see what insights we might be able to learn about what's driving that.
Yep.
Okay. All right. So next up is, as I mentioned at the top, right, in our never-ending pursuit of not only trying to give you more information, more ways to access it, more ways to utilize it and understand it without having to spend a ton of time on it. Industry research, which many of you may or may not have looked at, is a tool that Steve and I love, and continue to think about how can we deliver more to you through this link. So I'm going to let Steve talk a little bit more about what we've done and in particular what he's done to kind of bring industry research to more life.
Sure. So I want to just back up for just a second and kind of take everyone through for a minute, kind of how we've evolved in our offerings when it comes to industry research, industry trends. So research that's not focused specifically on your absolute right performance for an individual bank or even yours relative to peers, but just the trends for community banks, and then certainly you can overlay your trends to see from a comparative standpoint. The first thing we developed was what we call the QCBI. QCBI stands for QwickAnalytics Community Bank Index. This was just our way of finding a research tool where we could kind of exclude all the national, regional institutions, internet banks, trust companies, bankers banks, et cetera, that didn't operate like a traditional community bank. And what would be left with would still be the vast majority of banks in the United States. And that's what we would call our QCBI index. And we could use that index not only to track performance on a community bank only basis, but also track things like market share, deposit market share. When you go to the FDIC's website and pull up a deposit market share table, if you're trying to compare your growth at the branch level or your footprint to other community banks only, it's pretty challenging to do that on the FDIC site because you're stuck with Wells Fargo and Bank of America and everybody else right on that same table. So the ability to exclude all those guys and then compare footprints and deposit trend growth and branch level growth and everything else on a community bank to community bank basis, we found has a lot of value. So we designed and built the QCBI index, and we used that to design a relatively static performance report. We just call the QCBI performance report. I know a lot of you on the call run that on a regular basis. It's a great tool to provide to your board on an annual or a quarterly basis to just show trends in community banks in your state versus the country. And so we have a national version of this report, and then we have a state version or a custom market version where you could say, my state is huge and I just want to focus on, these few counties. So you can build a QCBI performance report on a handful of custom counties or markets. But what you get is a static PDF, 25-page report that has specific trends and specific metrics. And the way we think it's helpful to visualize these trends over time. So on the next slide, just kind of an idea of what that universe looks like, the industry structure. As we know, consolidation continues over the last few years. We've seen the number of QCBI or community banks decline from close to 5,000, 6 or 7 years ago to just over 4,000 today. And we break them down by asset size. We break them down by charter type, by ownership type, et cetera. And then we do a bunch of performance metrics as well. So the next slide is just an example of one of those performance metrics that we have on our report, where we'll show, for example, net interest margins, right? We can see the trend in net interest margins amongst community banks over the last few years. Then we kind of slice and dice it so you can see, what percentage of the banks in your market or in the country have a margin close to yours. So for example, 25% of the community banks in the country are between 3 and 3.5%. 9% of the community banks in the country have less than 2.5% net interest margin. And then the chart on the right-hand side just does it by asset size. So you can compare yourself to other similar size community banks and see what happens as you grow. We kind of know intuitively that margins are higher for community banks than they are for larger institutions. So as you can see, the larger a community bank gets from that under 100 million to up to over $1 billion range, we typically see a slight decline in margins at any given point in time as you grow. Fee income, just below that, the opposite. Obviously, larger community banks typically have a much higher fee income base than smaller community banks does, which probably shouldn't surprise anybody. The idea is this is how we presented industry trends. And there was some great visuals here, but there was no flexibility in what peer groups exactly, what metrics, and how you wanted to visualize them. Next slide. Enter the industry research 1.0. 1.0 was just, we called it industry credit research, and it was focused very much, we built it along with the CECLSolver tool to provide a more interactive experience with peer trends, so that you could really dive down and get better justifications for your Q factor adjustments or what have you, or try to just get more granular detail on a visual nature when it comes to credit trends. So it allowed you to pick a credit metric, like let's say 1 to 4 family or a loan type, 1 to 4 family residential, first liens, a metric like 30 to 89 days past due, 90 plus, non-accrual, charge-off, recovery, net charge-off, etc. And then if you wanted to visualize that as a percentage, just a percentage of a loan balance. So you could pull that up, which is what I happen to do here. I chose for a peer group, I just chose all the community banks in the state of California. And over the last 4 years, this is the trend in past due 30 to 89 days for first lien mortgages as a percentage of the portfolio.
And Steve, I just want to jump in real quick. And you could do this by years. Again, Steve's going to get into this, but I think again, there's a whole lot of flexibility for you in this, right? And so all of these pages are exportable to PDF or Excel. And so again, as Steve touched on, when we built this initially, we were trying to find ways, while a lot of this information is available to you throughout QwickAnalytics in different ways, this was a quick way to come in, pull something down specific, be able to build more substantiation or show a historical trend or comparison, relative comparison, whatever you were trying to do. We just wanted to kind of unlock it all for you in an immediate fashion. All right, sorry.
Yeah, Steve. And what I wanted to point out here was, so we've had this on the site for a little while now. I wanted to talk about the methodology that we used here because it differs from the methodology we're using for expansion of industry research with performance analysis, performance trends, and everything we're going to be adding to it. So if you head to the next slide, you'll see that. So when we did industry credit research, the data is presented right below it. This is what's already around on the existing site. We did weighted average calculations, which means that we would take a numerator, meaning all the loans 30 to 89 days past due for mortgages in that from that peer group. So adding up all the past due loans in that entire market as the numerator, and the denominator was adding up all the loan balances of loan balances of that particular segment within the peer group. So what you're doing is you're calculating a weighted average. You're not taking that ratio for each bank and just doing an average or a median of the resulting ratio. And the reason that we use that methodology, I'll get to in a second, but it presents results that are more easily trackable over time for metrics like credit metrics, which have been so benign for so long that if you just took a median value, right, you would end up with all zeros, because more than half the banks in the country, if more than half the banks in your country have zero for a particular segment for past dues or non-accruals, then your median for the entire peer group is going to be zero, which is not particularly helpful for spotting trends and seeing weaknesses and tracking the results from that perspective over time. So the way we had developed the methodology for the credit analysis is to use a weighted average. And this is right on the site. Whenever you choose one of those, it shows all this data below, so you can see how many banks are in that peer group over time. This is community banks in California. So that number, you can see the number of banks changes over time. It's decreased from 110 4 years ago to 97 today. And you have an aggregate number of past due loans, an aggregate balance of total loans in the market, and a resulting weighted average past due ratio. So let's compare that to the next slide. So yeah, that's right. So pros and cons of this methodology. Pros of using a weighted average methodology means it captures all the losses in the market, as I mentioned, irrespective of from which institution they originate. It's easier to spot directional credit trends during a healthy part of the credit cycle when the majority of institutions are maybe showing zero. And again, as I said, the effect is exacerbated the more granular the level of detail. If you pull up total loans 30 to 89 days past due, even at the median level, you're going to get some values. But if you start looking for specific segments of the portfolio, you're going to get a whole lot more zeros for any individual institution. The cons of using a weighted average methodology is that there's not much else you can do with it, meaning you're not able to stress your results at various levels of adversity. You can't see what the 25th percentile is or the 75th percentile. A weighted average is simply a weighted average. You're also, so it means you're unable to see what's happening at the margins distinctly from the average experience. You can't say, what are my top performers doing when you're calculating a weighted average? It's just simply in a vacuum to an extent. So let's take the next slide here and contrast that with our newer performance metrics, which are not limited to credit analysis. In that Omni search box up there on the top left, you can type in any field in our entire database. So thousands of fields in our database. You can start typing and searching for the field ID or the name, the label for it, or you can click select from a list of fields, and that'll give you kind of an organized by performance category list of fields, and you can choose the field that you're looking for. And then once you've chosen a field, you're adding a peer group, and you can choose multiple peer groups. But then the way this is different is you plot, by default, it plots a median value for the peer group over time, but you can also choose a second percentile rank. So you can look at the median and the 75th percentile, for example, for that peer group. This perfectly illustrates what I was talking about. If you pull up on the performance analysis, if you pull up loans 30 to 89 days past due for mortgages, just like we did on the previous one, remember the weighted average one had non-zero values and it kind of went up and down over time. If you just pull the median for a large peer group of community bank or California community banks, it's all zeros, because more than half of the community banks in that peer group at any given time have zero loans past due for that particular segment. So the median value, not really very helpful for short-term periods during a healthy part of the credit cycle. But we kick in the 75th percentile, you start to see a trend that looks kind of like the weighted average, where you can see ups and downs over time, and you can see when things are relatively getting worse, deteriorating, or improving. And you could also see what top performers or bottom performers look like separate from the average, so to speak. So in our performance analysis, and the zero problem, as I kind of call it, it doesn't relate to the majority of fields. It really just relates to fields like credit specific fields that tend to not have very much non-zero data during certain parts of the credit cycle. But for other parts of performance, margins and fee incomes and profitability and all that kind of stuff, you don't really have those kind of issues. So if you head to the next slide.
Yeah, Steve, I just want to make one comment about this. And
sure.
Reemphasize something that Steve, touched on, right? Is again, we have always kind of at the foundation of QwickAnalytics looked at the median. But again, I think in instances where if you want to start to see, and we talk a lot about directions changing, right? They're going to happen at the highest and lowest percentiles, depending on which metric you're looking at, right? And so I think to Steve's point, this just gives you potentially some insight. Is again, most banks not being affected, some banks are, right? Is that trend quarter over quarter, year over year getting better or worse? Whatever. This just kind of gives you some visibility into seeing that, right? And so I think that's where we just feel like this is just another step, another tool just to let you dig a little bit deeper than maybe what it seems like the headline story is. You can just see if there's anything happening at the edges or at the fringes.
Yeah, so on the next slide, I kind of revisit the pros and cons, and as you might expect, they're kind of flip-flopped, right? The pro of using percentile ranking peer methodology is that, a median captures the most typical experience of your peers. So if you're comparing yourself to your peer group and you want to see if you're above or below the typical experience or in line with, a median is a great way to do that, and it has equal weighting to each peer's experience, right? Which is the opposite of a weighted average. It's very easy to stress results at various parts of the credit cycle or any other cycle and spot trends at the margins. You can tweak it. You can have 25th and 75th percentiles be your two comparisons. So instead of kind of seeing if you're above or below the midline, you can just see, are you within a reasonable range, right? Are you kind of in the spot where you're not massively outperforming, but you're not massively underperforming? Depends on how you like to conduct comparative analysis. And again, it gives you the ability to distinctly analyze trends you're seeing amongst high performers and low performers separately from just an average or blended experience, which is what the weighted average provides. The con, well, we just talked about lots of zeros at the medians for credit type, credit related trends, and more exacerbated when you go at a granular level. So if you look at, asset quality detail page and you're looking at median, net charge-offs at the segment level, you're going to see a whole heck of a lot of zeros unless you go back to 2009, 10, 11, 12, 13 at the median level. So just keep in mind when you're looking at medians, you're thinking about percentile ranks, and you really want to consider a range of percentile ranks. All right, I think we've covered that. Let's move forward. Yeah,
Yep.
so our the CECLSolver user database trends. I know I mentioned this each time, but it keeps growing and it keeps getting better and more accurate. And I know a lot of you are looking for this data even on a even more timely basis. And so we wanted to make sure that when we update this stuff, I mean, a lot of times historically we're updating it or gathering all the stuff from the previous quarter during that time that you're filing, so it's available by the time the filing date is. However, that doesn't give you current quarter trends during the time where you're evaluating what the reserve needs to be before you do a true up or anything else. So we were trying to get that data to you pretty much right around in conjunction with the end of the quarter itself. And so we're able to do that. Our third quarter trends are actually live on our site as of this morning. We had to, well, the last 5 days of the quarter are not in there. So we'll do a little true up of our own sometime in the next couple of weeks. I'll update that to include the last few days of the quarter for any scenarios that were built during the last week of September. But we want these trends to be real time or as live as humanly possible. So I went ahead and compiled the thousands of scenarios that our users have run during the third quarter up till a couple days ago. And that data is now available. So you can go onto the site right now. There'll be a column for third quarter of 2025, and you can see what direction warms have been headed over the last quarter, Q factors, and the collectively assessed reserves by segment. So we can see here, just it's funny just looking at the screenshot on the screen right now. It's an interesting trend just looking at it for the first time, Sean, looking at collectively evaluated reserves to loans. So the kind of the old general reserve, right, to loans, just for mortgage loans. Looking at this chart on the right, you see there used to be, even 2 years ago, there was a pretty wide difference between 25th percentile reserve and 75th percentile reserve, right? And over the last 2 years, the banks at the 25th percentile, so those banks that are reserving more than 25% of their peers, but less than 75% of their peers, so reserving a little less than average, has remained pretty consistent. The median or 50th percentile reserve, general or collective reserve on mortgage loans has trickled down a little bit over the last couple of years, but at the 75th percentile, it's come down very significantly. So that means there's just less variation amongst community banks in their reserve levels. It's becoming more, I don't want to say standardized, but yeah, I mean, relatively, it was already pretty standardized. It's even more relatively standardized than it was 2 years ago. And so that's, and with a general slightly downward trend, which is what we've seen for community banks for their entire reserve, right? There was a bit of a spike when CECL became a law of the land, and everyone was expected to possibly increase their reserves, whether it was warranted or not. And since that time, asset quality has stayed relatively strong. And so overfunded banks have slowly kind of backed out little bits of those reserve, or maybe just not provided very much while their portfolio has continued to grow into that reserve, so to speak. over time. So some very good trends that you can visualize by utilizing this tool, and it's already updated for Q3.
Yep. Yeah, and again, I just think if nothing else, right? I just always love trends just to see which way we're going, and if it makes sense with kind of how we're feeling, about our our own current our own current outlook, right? And so I always just try to see if there's directional changes, and that graph, right, really does show you that we have over time we have gotten, as Steve kind of put it, I want to say standardized, right? We talked last coffee talk just about where reserves have kind of moderated to. And so again, if our outlook starts to um, decidedly change, right? That's part of what CECL was about, was trying to get ahead of that again, right? And so I think it just gives you a good foundation, to identify if and ever there is a need to change, where we've come from and where you think you might be headed. So.
Yeah, and we always get requests as soon as people start looking at the CECL our internal proprietary CECL trends on the interactive site for an update to the Excel file that has kind of compiled all that data over time. So that is also already updated on our site. So we'll have that Excel file when you click on the Excel export. It'll pull the data all the way up through 3Q25. And if you're looking for longer term trends, you can always, there's hidden columns there on the left of each section, and you can unhide them and look all the way back to 2021 with quarterly data going back 3 or 4 years with our user trends.
All right. Anything more on this slide, Steve? Let's keep moving on.
I think I'm trying to see if there's anything I'd like to point out specifically. Yeah, I'd like to so we have a minute or two here. I'd like to just show the industry research that I was kind of going through. I know I just had some static slides. I'd like to share
you want
that
to go
for
out to the
just
live site?
a moment. Yeah.
Yep.
So let
Go ahead and take it.
share the screen. Oh, there we go. All right. Can we see it? Yep.
Yes.
All right. So again, on the live site, if I went to, well, let me just open up a new tab here. Here's a login site. There is where industry research is. And when I click on that, comes here. The existing, what's been there for a little while now is what I said, the credit analysis. And if I were to choose, let's say, 1 to 4 family mortgage loans, and I want to do 30 to 89 days, and I want to do 1% of loans, and I want to add all the community banks in California. So QCBI California research. As Sean was mentioning, there's a lot of flexibility in the durations and timelines of a chart. So if I wanted to go back and look at a longer quarterly trend, I could do that. And there we have going back to the first quarter of 2019. If I wanted to look at year-to-date numbers instead of quarterly ones, or years, annual, click on that. And that'll give me a trend going from, we can go all the way back to 2007, for example, to 2024. So we can get a very long-term trend or short-term trend, and you can add different research groups here, and the data is right here. So when you scroll down, you'll see this is the date. These are the number of institutions in the peer group as it changes over time. Here's the aggregate amount of loans past due. Here's the aggregate balance of those loans amongst all the banks in the peer group. And there's a resulting weighted average ratio tracking over time. Now, comparing that to, here's the new section, right? Performance analysis. I already kind of pre-filled this. I cheated a little bit, but I can search for, if I type in, I'm looking for 30 to 89 days past due. I start typing in 30 to 89. I see all these different segments. There's the first liens, and adding peer groups. I can add whatever peer groups here. The national, the state peer groups, with or without, including just community banks or everybody in the state. And then here are all the UBPR peer groups you could use, or any of the custom peer groups that you've built in the past. I build lots of custom peer groups, so you can see them there, and you can add multiple peer groups. Let me delete this one. There, so let me just start that one from scratch. If I want to go, just build this one more time, I can show you I did a couple. If let's say you want to look at this over time and you want to compare different size banks within your state or your market, I just created a couple custom ones before the call, and this is just all the community banks under 100 million in the U.S. And there's that trend over the last 5 years. There's median values, and here is 75th percentile. Or if I want to have a nice little range, I can go 25th to 75th. So I have 25th and see 25th percentile, lots of zeros, so not particularly helpful there. So I can go median and 75th, or I can remove that, and then I can add a second peer group. Let's say I want to compare to 100 to $500 million community banks. So we have a median value for one peer group, and then alongside it is going to be median value for the next peer group. So as you can see, unsurprisingly, a little higher past dues for the slightly larger community banks. And again, you can go and overlay any of these economic trends like GDP growth and make it, I'm going to make it teal, Sean. I'm going to go with a teal overlay. And there we go. And there's we all remember what happened there. and that trend since then. So, and then when you scroll down here, there's a different way to visualize these because we're not using aggregated numerators and aggregated denominators like a weighted average. We're just using a median of the ratios for all the banks in the group. The way we show a chart of that data is here as well. So you can always come and get this as a PDF. And we get that chart with all the peer data right there, or Excel. And the Excel file is going to have the chart as well as right there. The existing the chart as well as all the data that goes into it. And the economic trend as well. Any economic trends are going to go there along with the time series. So all the time series are in the table. I believe that's all I wanted to show. As far as the unfunded commitments that we're still developing right now, I believe I showed it on the screenshot, but you'll still be defaulting to the current method, and then you'll just be able to toggle over, see the results of a simplified method, save them independently from each other, and then choose which one that you want to use right here in the summary. So that's how that works.
Perfect. Yeah, again, I think certainly encourage you to go out there and take a look at it. Again, it's a tool we love. It's a little bit more immediate. It allows you to free form a little bit and just look at a lot of different trends. But again, I think we find it to be a really invaluable source of information. All right, let me grab this back from Steve. There we go. Okay. One last chance for questions while we're waiting to see if any of those come in. Just a reminder, all of our past productions are out there on our YouTube channel. Again, if you're looking for more data, and some of you may have attended some of these portfolio analyzer webinars, but you can dig down into all of your loan level data through our portfolio analyzer tool. We continue to make a number of enhancements. I was discussing a couple of those with David Littleton yesterday on a call. Again, I think just really a great tool to manage and for your administration team to manage the, just kind of some of the day-to-day responsibilities that they have. Next month, we're going to be pleased to have Paul Allen from Saltmarsh join us again for the coffee talk. So certainly register for that. October 3rd, we will have a coffee talk, finding profitable loan growth. So a couple of reminders to register for our webinars. Even if you don't attend, you will receive an email with a copy of the slides and a link to the presentation. Let me just check this question here real quick. Okay, so we did have a question come in on your reserve historical data chart. Is that indicating Q factors within the sample are 88% of the overall reserve levels, i.e. 109 to 124? I would assume that includes forecast adjustments in Q factors. Steve, I think go back. I think on this slide.
Yeah. Yeah,
I
let's
think,
just go back to the
yeah.
screenshot of it. What that means that's Q factors, a Q factor adjustment in a vacuum. So by itself, that Q factor adjustment means that on just looking at the first one for third quarter for mortgage loans, it says 94 basis points. That are 94, yeah, 94.94%. So that is the median or 50th percentile Q factor adjustment. So adjustment to the historical data. So let's say you have, you know, you need a reserve of about 1.1% on your mortgage portfolio. And historically, over the last few years, you only have 10 basis points of losses. So the historical element of the calculation is going to be 10 or 15 basis points. The Q factor adjustment is going to be 94 basis points. And so the total reserve is the historical plus or minus the Q factors of 94 basis points equals the total expected loss rate of, say, 1.1%.
And Doug, hopefully that answered it. If not, certainly follow up with us. Let's see. Oh, perfect. Thank you. Let's keep moving forward here. Just a reminder again on those webinars, certainly register for those. Paul Allen will be back in November with us, so we always look forward to Paul joining us. Always an informative coffee talk, so please register for that. With that, I don't see any additional questions. Steve, any final words for our friends today before we let them have their day and the weekend?
No, I'm looking forward to fall. We had some fall in the late summer here in North Carolina, and then all of a sudden it decided to be 92 degrees out yesterday. I don't know where that came from, and now it looks like we're maybe getting a hurricane next week. So, always a new day, new weather phenomenon here in the Carolinas. So good luck with that, everybody, and wish me luck. I'm driving across the state tomorrow morning to possibly pick up a new puppy for the family. So might be the last time y'all hear from me.
Well, awesome. Well, enjoy the ride and congrats on the new puppy. Thank you all for joining us today. Let me see. Good luck as well. Thank you for joining us as always. Reach out to us at info@quickrate.com if you have any questions or need any additional support. Good luck with the third quarter call reports. And, again, thank you for continuing to show up. We appreciate it very much. And we hope you have a great weekend.
Thanks, everybody.
See ya.